Bismillahirrahmanirrahim. Assalamu alaikum and welcome back to another very important topic, that is the integrated reporting. This is a word that we all have been hearing about, but many of us do not have a good understanding of this. And I'm sure that after this lecture, you will confidently say that yes, I have a good understanding over the integrated reporting. All right. So the integrated reporting, what it is. It is basically a concise communication. It's a concise communication demonstrating a link between, it is a kind of communication. It is a kind of disclosure, all right, from a business. And this communication is concise, all right, and this communication actually creates a link. It creates a link between the governance, financial performance, strategy, social and environmental context. you know the traditional reporting, the financial reporting, it only deals with the financial statements or the financial results. At the end of each year, every company makes its financial statements, gets them audited, and then issue the financial results to the public. All right. And you get to see that, at the start of the year, what was the company's position during the year, how much profit company earned, from revenue, cost, your admin cost, your distribution cost, finance cost, other income, other expenses, and then finally, after tax and profit, you get the profit figure. And on the balance sheet, you see that what are the assets of the company, how much equity company has, the liabilities, your cash flows, your changes in equity, and then the notes to the financial statements. These all things only talk about the financial results. But you know what? When I talk about the company's performance, when I talk about the company's performance, in company's performance evaluation or company's performance analysis, there is not only the financial things or the financial aspects, there are some other aspects as well. And the financial reporting only focuses on the financial aspects and it ignores the other aspects. Assume this thing that, if you have a good understanding that the financial statement, they tell you the historical data, they tell you that what has happened in the year which passed, what happened, it tells you this thing. But what will happen, how much successful the company will become, what challenges the company will face, what are the plans of the companies, will the company grow, and if yes, then how much it will grow. Because as a shareholders, you are concerned about the future. All right. Obviously, you want to know the performance of the year which passed on, but you want to know about the future as well. And these all things, integrated reporting is the solution for all these issues. Integrated reporting, it starts from the governance, because obviously in any organization, there is number one thing, your governance. What are the status of your governance? How good the board of directors are doing your governance, whether they are able to achieve the missions, whether they are able to achieve the objectives of the company or not. Obviously, there can be some missions, some objectives that are non-financial as well, and you need to consider them as well. All right. Then the financial performance as well. In the integrated reporting, by connecting this, by doing a good governance, what are your financial results? You create a link with them. What was the governance rules or the governance actions or the governance ways which led you towards this financial performance. And these board of directors, the governors of the organization, how good strategies they are making, what strategies they have made, what strategies they have for the future issues, future challenges, future risk and the opportunities, that you need to understand. All right. And then the social and the environmental context. A company is operating in a environment, it's operating in a society, and this society has the social life, it has the environmental aspects as well. So how much you have contributed to the environment and the social well-being. what benefits you have taken from the environment or the society, and what you are giving back to them. So this all reporting you should be doing, because your performance is actually not only the financial aspects. It is not only the financial aspects, it is this governance, your financial performance, your strategy, and also the social and the environmental context. And these all things actually explain or disclose to the shareholders that how an entity is going to create the value in the short, medium, and the long term, because these financial results, they are only short terms. But when you know combine the financial results with the governance, with your strategies, with your social and the environmental footprint, then you get the bigger picture, and you get the bigger picture for the long term, like 5, 10, 15 years. All right. So, you know if we talk about the differences between the financial and the integrated reporting, if I talk about the differences between them, so the financial reporting or the financial statements, they only focus on the financial information, as we discussed, right? But the integrated reporting, it doesn't focus only on the financial results, it focuses on your governance, how well your governance is, how effective your governance is. All right. How good strategies, how suitable strategies you are making. What are your plans for the future risk and opportunities, for the future challenges, for future growth? And what are your financial results as well, along with your social and environmental aspects. So this gives you the overall performance of the business, not only the financial performance. All right. That's the benefit of the integrated reporting. Then it provides you the historic performance. The financial reporting, it provides you the information about the year which passed. But the integrated reporting, it is focused on the future, that how you are going to deliver, how you are going to perform in the future. Because if you are going to purchase the shares of any company, also you obviously, I am not saying that you will not look at the results so far, but you will also like to know that how good this company is going to perform in the future. All right. And that is the main thing you should be concerned about. So the integrated reporting actually provides you this information about the future strategies, about the future status or the future growth of the company. The financial statement, it only focuses on the share capital, your monetary capital. But the integrated reporting, it talks about the six capital. And we are going to cover these six capital in detail. But right now, I'm just telling you that six capital, there are six capital, six types of capitals which an entity uses. And integrated reporting talks about all of them. And the financial reporting, it only talks about one of them. Obviously, who is giving you the comprehensive information? Integrated reporting. It is less emphasized on the social and the environmental aspect, because it's only focusing on the share capital. And the integrated reporting, it also focuses on the environmental and the social capital as well. One capital, two capitals are these: social and the environmental capital. So it focuses on the social and the environmental aspects, and if you are focusing on them, you are focusing on the society. Then society is going to support you. Then the society is going to give you the benefits, right? And ultimately, you will grow. One thing is that many students, they argue from me that, sir, if I talk about the financial statements, we have balance sheet, we have cash flows, we have profit and loss account. All right. So by looking at them, we can actually talk about that how the company will perform in the future, because if they are performing good in the past, they will perform good in the future as well. You have assets here. These assets are going to give the benefits to the shareholders, right? So they are going to give benefit. Then why you need the integrated reporting? The thing is that these financial statement information, it is going to give you information about the future. I don't disagree, but it is only going to give you about the short term or the annual result, like 1 or 2 years ahead. It will tell you that how good the results are going to be, but not for the longer period, like 5 years, 10 years, or 15 years. All right. And if you are making the long term decision or long term investment, huge investment into some sector, some company, or some business, you should know about the long term period, right? And that is what the integrated reporting tell you about? How? By looking at the six capitals. All right. Now we have, the contents of the integrated reporting. So if I talk about the contents of the integrated reporting, this is not the list, that is the exclusive list, or I would say exhaustive list. It's a indicative list. In many reports, usually you will see that these contents are made part of any integrated reporting which is done by the large listed or the multinational companies. But there are chances that few companies would skip out few of them, or maybe they will provide some additional contents. So these are the most majorly used content of the integrated reporting, and what they are. Number one, you have to disclose first that what are the organization's overview, organization overview, that what business you are doing, what are your objectives, what are your mission, what are your vision, what are your values, how you are going to survive in the future, what are your strategies, what are your plans, what risks and opportunities you are going to face in the future, how you are going to avail them. So on a macro level, you actually provide the organization overview. That means that so far what have you been, what have you achieved, and what are your plans, what are you trying to achieve. All right. Then the external environment analysis. How many of you are able to recall this word? This is something that we have already covered. The external environment analysis, the pestle analysis, Porter 5 forces, right? So the external environment analysis to identify the risk and opportunities, you present or you disclose this information into the integrated reporting, that we have performed the pestle analysis, we have performed the Porter 5 forces analysis, and these are the risks and opportunities which our company is actually facing, and we will have to deal with them in the future. These are the opportunities which we may capitalize and become better. We can grow. These are the risks which are going to create threats on us. All right. You mentioned these kind of things. Obviously, these are forward looking. SWOT analysis. Remember that we perform the SWOT analysis, that these are our strengths, weakness, opportunities, and threats. And based on them, we are going to make our approach. So whatever you have done, whatever the analysis you have done, you actually disclose this thing into your integrated report to your shareholders, to your stakeholders, so that they can make a good understanding of the company's performance and the future aspects. All right. How organization create the value, what are the areas in which the organization is creating value. Creating value means earning the profits, increasing the wealth of the shareholders, and how they are actually giving back to the society, how they are adding value to the society. So that you need to actually disclose there. Future plans and the strategies of the companies, key risks that you are facing, six capitals. You have to provide the details about the six capital, and I will tell you that how you are going to do this. I will also explain that what are the six capitals. Just stay with me. All right. And what focus on what I am telling you right now. Social and environmental initiatives. All right. This is we are going to cover in our dedicated chapter lecture, that how you actually analyze your social and the environmental footprints or the environmental impacts on the environmental or the social initiative, and how they are going to give you benefits, and how you're going to actually make them part of your report. All right. So now we have some questions. These are some questions that an integrated reporting should answer, right? So these are the typical question that you need to read like one or two times, and these are the question which your integrated report should answer to. you know if your integrated reporting is able to answer as many questions from this list, then your integrated reporting would be considered as good. If your integrated reporting or the integrated report is not able to answer large amount of questions out of this, then your integrated reporting is not good. All right. So don't need to worry about it, don't need to bother on them. Just read them like one or two times, and just keep it in your mind that these are the questions which are addressed in the integrated reporting. All right, these are the information which you will get if you will read any integrated report. All right. So now let's come to the main area of the integrated reporting, which are the six capital of the integrated reporting, and we will understand them in detail one by one. So first of all, we have the financial capital, and I have no doubt that none of you will say that sir, we don't know about the financial capital. The financial capital means the financial resources that are available to the company, that are available to the businesses, right? The cash, bank balances, or the debt, that is also your equity, right? This is also your resource. If it is coming from equity or is it coming from debt or loan, these are the financial resources, right? Which you have. So what are how many financial resources you have, all right? And how actually you perform, you provide the information about these capitals into the integrated reporting. Let me tell you one thing, that how many of you has made that T account or general ledger? If you have not made, let me tell you that you actually tell the people about the opening balances, all right? Opening balances, movement movement in the opening balances, that means either they increase or they decrease, all right? And the closing balance. So you actually reconcile that, at the start of the year maybe your financial capital was 100, and at the end of the year it rise to 120. So from 100 to 120, that's the distance or that's the journey which your company made. So you have to tell the shareholders into your integrated report that how you grow or you grew from 10 100 to 120 dollars. All right, that is called the integrated reporting. That is called the reconciliation from the opening balance to the closing balance. So not only you will tell that what are the financial capital, what are the financial resources which you have, you will also tell that at the start of the year what financial resources you had and what changes in the financial resources came during the year, and after that ultimately what is your closing position of the financial resources. All right. Then manufacturing capital. The manufacturing capital includes all the tangible assets which contributes to the production of the output other than being input to the product. The manufacturing capital means all the tangible assets that contributes to producing the output, like your machinery, your plant, your factory, your robots. So these are the manufacturing capitals. These, or you can say, if you have made some plant, some machinery, some website, these are helping you to provide the outputs. So again, website is intangible, so I'm not talking about it, right? So these are actually which are not becoming part of the input, but they are helping you to provide to generate the output, right? And these are your manufacturing capitals. What they include: example, plant and machinery, building, factory, infrastructure, your tools. They are used in the production, right? They are used for production, not in the production. You don't put it into the machine and use the tool and make a product. No, you use the tool to produce a product. All right, and these are your manufacturing capitals that helps you to produce something. And you need to again disclose that what was the opening status of these manufacturing capital and what is the closing status of the manufacturing capital, and during the year what changes occurred. All right. Then intellectual capital. It means the intangible asset which helps organization to drive profit, gain new customers, create new product, otherwise improve the business. For example, your goodwill, patent, brand, knowledge of the employees, R&D, other informational resources, your customer relationship data, your data analytics tool, your website, any kind of patent or brand which you have or goodwill. Again, these are the assets, right? These are your capitals because they are going to give you benefits. All right. So you need to disclose first that what is the opening status. At the start of the year, what was the status, and during the year, what increase or decrease happened, why it happened. All right, and ultimately at closing, what is the position and how you are going to use this closing balance or the closing capital or the closing resources for the future coming years. All right. Then human capital. Again, sir, these are your human resources. These are your workforce. It includes that, the knowledge, skill, and experience, motivation, productivity, turnover, and satisfaction of your employees. So how much skill, knowledge, motivated, professional, productive staff you have. If you have a high turnover, that means that you are not able to retain a good staff. All right. If you have a low turnover, your employees are satisfied with you. You are able to attract the qualified, knowledgeable, and skilled professionals in the workforce. Again, they are going to create the value for the company and they can contribute towards the growth of the company, right? So you have to tell that, what was the status of your workforce at the start of the year? What was the status, that how many skilled, knowledgeable, and trained people or the motivated people you had, and at the end of the year, how many you have? What happened to them during the year, and ultimately from closing, you will tell that how you're going to actually deliver in the future. All right. Then we have the social capital. So social capital is relationship and the trust that you build with each stakeholders group that supports the well-being of the organization. Again, social means the relationship with the society. So social capital is actually about your social resources, how good relation you have with the society, with all the stakeholders in the society, your customers, the suppliers, government, pressure group, NGOs, hospitals, charities, you can say the tax authorities or the union, employee union, every kind of, stakeholders you need to check, because if you have a good relationship with them, you can use your relationship, and if they have trust on you, they will support you. All right. So again, from opening to closing, you have to make a reconciliation that what happened during the year and where you are standing at the end of the year into your this capital. Again, see, this is the perspective of looking at the organization from the wider perspective, that you are not only talking about the financial capital, you're also talking about your relationships as well, right? And then the natural capital. So the natural capital means the natural resources which your organization has from the environment. It includes the water, it includes the land, it includes the air, environment, and all the natural things which you are getting from the environment, right? So land, water, minerals, energy. These are the factors, and one more thing that this is one of the benefit from the nature to you is that whatever the waste you put into the nature recycle it, the nature decomposes it. Because if the nature doesn't do it, because whatever the dump or the pollution you are putting into the sea, river, where does this go? Nature recycles it. Nature decomposes them. That is how the nature is helping you, because if nature stopped doing this, then you would not be able to handle this, right? So that is the natural capital, that how nature is giving you this benefit by giving you these resources, and not only that, the nature is helping you to recycle things as well. So this is your natural capital, right? And you have to again tell that at the start of the year, what was the status of the natural resources, the scarce resources which you are getting from the environment, and at the end of the year, what is their status? How much benefit you have given to the environment? How much you have given the improvement to the environment? And how much natural resources you have used? In what way you have used? And all kind of stuff. So this was about the integrated reporting six capital. Now at the end, we have some advantages and the disadvantages, which are more or less what we have so far discussed. All right. So now quickly let's go through them and wind up our today's lecture. So the advantage is that AR, the integrated reporting, is also called IR. All right. It's a voluntary disclosure. It enhances the organization image and reputation for the transparency. It's not mandatory, but if you are providing this enhanced disclosure or the information to the stakeholders, obviously their trust, their relationship with you will enhance. It will get strengthened because you are giving them the information which they need, which can be useful for them. Effective communication with all stakeholders, because you are providing them effective or useful information. Demonstrate how organization can create value in future. All right. It also in the past and also in the future. Integrate social and environmental aspects in strategies and decision making, because now you know that if you are not going to embed your social and environmental aspects into your strategy, then if you will do the integrated reporting, the people will kill you. So now you know this thing that in integrated report the people are going to check this thing. So you know back in your mind you make the strategies that are aligned with your social and the environmental aspects. All right. Focuses on six capital of the organization rather than the only one. Better understanding and decision making by the shareholders, stakeholders, and the potential investors. Attracts investment at a lower cost of capital due to availability of the greater information. Because when you have, you know, lesser amount of information, the risk increases. And higher the risk, higher the return your shareholder will demand. If the shareholder has high risk, they will demand a high return. So if you are giving them the enhanced information, their risk will go down. And if the risk will go down, the demanded return will also go down. And if they are demanding lesser return, your cost of capital will decrease. All right. As a business, you will have to pay less to your shareholders as the return. Gives competitive edge over the other companies because you are providing this integrated, transparent, or enhanced disclosure, which the other company is not giving. All right. So you will have the edge in the form of trust, credibility, and the alliance from the stakeholders. All right, and also from the shareholders as well, because shareholders are going to invest in your company because you are giving them this much information. Disadvantage is that balancing the risk of disclosing valuable competitive information with the benefits of the embracing integrated reporting. While I was explaining, how many of you were thinking that, sir, if we are going to disclose this much information, don't you think that we will actually expose ourselves? We will actually disclose our competitive advantage or our secret to the competitors? Yes, this is one aspect because this is the challenge or the disadvantage of the integrated reporting, that while giving such enhanced disclosure, sometimes there arises the risk that you might disclose your secret formula, your strategies, or your internal, confidential data to your competitors, which can be harmful for you. All right. It may not be successful in changing the focus towards the long term rather than the short term. Maybe some of your shareholders or some of your stakeholders, they are only concerned about the short term results. So if they are concerned about the short term results, then no matter how much long term information you give to them, it is irrelevant for you. It is not useful for them. Then regulation is not yet standardized between the jurisdiction, meaning that the rate and the level of the implementation remains variable. The integrated reporting is not mandatory in many countries. And also, if it is mandatory, there is no strict guideline or the minimum level of disclosure which every company has to provide. Unlike the IFRS, we have the IFRS which guide us that what disclosure you need to give in the financial or regarding the each financial item. But with the integrated reporting, there is no framework, no described framework which everyone can follow and provide a consistent integrated reporting disclosure. So that's one of the challenge. Then valuation of six capital is subjective in nature. Again, see, your natural capital, social capital, human capital, the intellectual capital, manufactured capital, and also the financial capital. The measurement of these capital, it's a subjective thing. It's not that much absolute that 2 plus 2 4. It involves so many assumptions, it involves so many estimates, it involves so many judgment, which actually creates the difficulty in assuming or determining their value and to disclose it, because if you are disclosing something you have to make sure that it is accurate and it is complete, and for that it is going to create a challenge for you. All right, so these are the advantages and the disadvantages of the integrated reporting. I hope that I was able to explain this very comprehensive topic with clarity to you all. See you all in the next lecture. Till then, take care of yourself. Allah Hafiz.